The truth most people avoid is this: compounding does not begin when you start investing. It has been operating the entire time. The only question is, in which direction? Every financial behavior compounds. Spending habits compound. Debt compounds. Skill development compounds. Health compounds. Relationships compound. Momentum is always building. The market is not the only thing that compounds. Your patterns do. And here's what most people overlook. These assets, productive businesses inside broad market indexes like the S&P 500, are the main driver for exponential growth in America, and they are easily accessible to regular working people. Ownership is not reserved for institutions. It is open participation. These indexes are not static collections. They evolve. Underperforming companies are removed. Stronger companies take their place. The system adapts as the economy changes, which means you are not betting on a single outcome. You are participating in ongoing economic evolution. But people blind themselves with unhealthy, toxic lifestyle choices, and in doing so, they unintentionally subdue their own exponential growth. They feed distraction. They feed consumption. They feed habits that suppress capacity, while ownership sits available. Use income to fund growth and preservation first. Tax-advantaged accounts. Long-term ownership. Small, consistent contributions. Participation matters more than perfection. And as income increases over time, contributions can increase with it, which accelerates compounding beyond fixed, static investing. Growth in income paired with growth in contributions amplifies long-term outcomes significantly. Major institutions participate long-term. Pension funds, corporations, governments. They position themselves inside growth. They don't wait for perfect conditions. They participate. Let's make this real. When people hear that the S&P 500 compounds, they imagine a line on a chart slowly drifting upward. That's not what's actually happening. The S&P 500 represents 500 of the largest companies in the United States. Those companies sell products. They generate revenue. They produce profit. And many of them return part of that profit to shareholders through dividends. A dividend is cash paid to you for owning the business. Now here's where compounding becomes mechanical, not motivational. Let's say you invest $10,000 into an S&P 500 index fund. And let's make this even more real. Imagine two individuals. Both earn similar incomes. Both live in the same economy. One begins investing $10,000 per year at age 25. The other waits until age 35. Historically, over very long periods, the index has averaged around 10% annually before inflation when dividends are reinvested. After accounting for inflation, a more realistic long-term expectation is closer to 8% annually in real terms. That return is not a straight line. It is not guaranteed. There are multi-year periods where returns are flat or negative. There are recessions where portfolios decline 20%, 30%, even 50% before recovering. Compounding does not remove volatility. It requires surviving it. Markets fluctuate. Prices temporarily shift because of fear, optimism, interest rates, politics, global events, and short-term uncertainty. Sometimes your $10,000 becomes $9,000. Sometimes it becomes $12,000. That fluctuation is volatility. Volatility is temporary. Destruction is permanent. Compounding can recover from price declines, but it cannot recover from permanent loss of capital caused by poor assets, excessive leverage, or forced selling. The base must survive for compounding to work. But zoom out over decades, and historically, the long-term average has remained positive, around 10% before inflation, closer to 8% after inflation when dividends are reinvested. Not negative, positive. And those temporary declines create something most people misunderstand. buying opportunities. When markets go down, consistent investing means you are purchasing the same ownership for less. You are buying productive businesses at discounted prices. Your fixed monthly contribution buys more shares, more ownership. When markets go up, the shares you accumulated during downturns reflect that increase. The value rises, so the system works in both directions. Down markets provide accumulation opportunities. Up markets reflect expansion. Consistent investing means investing even when markets are down, especially when markets are down, because the greatest threat to compounding is not market volatility. It is the decision to stop participating during periods of uncertainty. Because compounding is not about predicting price movements. It is about accumulating ownership over time. Now simplify the return. Imagine that long-term 10% average before inflation, roughly 8% after inflation, comes from approximately 6 to 7% business growth and 2 to 3% dividends. In year one, your $10,000 grows to about $10,800 in real terms if we use that 8% inflation-adjusted expectation. That $800 isn't magic. It came from companies expanding and distributing profit. If dividends are reinvested, they buy more shares. You now own slightly more of all 500 companies. So in year two, growth doesn't happen on $10,000 anymore. It happens on $10,800. Another 8% now produces $864, more than the year before. Not because the percentage changed, but because the base grew. Growth begins stacking on growth. Dividends buy more ownership. More ownership generates more dividends. Businesses continue expanding. Your share count keeps rising. That cycle, business expansion plus reinvestment, is the engine of compounding. Time is the dominant variable in that engine. An additional 5 years of compounding often matters more than chasing an additional 1% of return. Duration multiplies stability. Return fine-tunes it. Costs matter as well. Fees, taxes, and inefficiencies act as negative compounding forces. Small percentages that quietly reduce the rate at which your capital can grow over long periods. Minimizing unnecessary drag preserves the integrity of compounding. It starts slow, almost boring. Year 1 feels small. Year 5 feels steady. But by year 20, something shifts. The growth in a single year can exceed what you used to contribute annually. That's when compounding becomes visible. After 25 years of disciplined $10,000 annual contributions at 8% real return, your portfolio grows to roughly $790,000. That's the power of structured consistency. Contributions plus compounding over time. Nothing extreme, just structured consistency. But extend that same $10,000 annual contribution to 35 years instead of 25, at that same 8% real return, and the portfolio approaches $1.7 million. Nothing changed except time. And remember the two individuals. The one who began at 25 reaches that 35-year mark at 60. The one who waited until 35 reaches only 25 years by 60. 10 years of delay compounds too. Same contribution. Same return. More duration. Compounding is not linear. The final decade often contributes more growth than the first two combined. The acceleration happens late, which means the most powerful variable is not intensity. It is consistency plus time. And here is where the strategy evolves. During the accumulation phase, dividends are reinvested to accelerate ownership. But during retirement, the objective shifts from maximum growth to sustainable income and stability. You stop automatically reinvesting dividends. You adjust your allocation, often blending broad equity exposure with more stable, income-oriented assets. So the overall portfolio produces a higher and more predictable dividend yield, commonly around 4% when structured conservatively. Dividend yield is the percentage of your portfolio paid to you annually as income. If your portfolio reaches $1.7 million and yields 4%, that generates approximately $68,000 per year in dividend income. That income is produced by underlying businesses distributing profit. You are no longer relying primarily on selling shares. You are living on cash flow generated from ownership. It is important to understand that yield alone does not equal safety. Total return still matters. Sequence of returns matters. If markets decline sharply early in retirement while withdrawals are occurring, the long-term outcome can be affected. Even the smartest growth plan can stumble if withdrawals aren't structured. That is why allocation shifts towards stability and diversified income sources become critical as retirement approaches. Proper structuring reduces volatility while preserving purchasing power. Tax positioning also matters. Tax-advantaged accounts, such as Roth accounts, can allow qualified withdrawals to occur tax-free, while taxable accounts handle dividends differently. Over long periods, tax efficiency is not a small detail. It meaningfully impacts how much of your compounding you actually keep. Structuring where assets are held influences the net outcome. Withdrawal strategy influences longevity. Structure influences durability. But the principle remains consistent. During growth, you reinvest. During retirement, you harvest. And if the portfolio is built correctly, the principle can remain largely intact. It continues producing. It can still appreciate modestly over time. And when transferred to the next generation, the same ownership structure can continue compounding. Your children can reinvest the dividends again. The acceleration cycle restarts. The machine does not disappear. It transitions. This is the full arc of compound investing. Accumulate, reinvest, endure volatility, extend duration, adjust allocation, harvest income, transfer ownership. Same mechanism, different phase. Compounding is not a promise. It is a multiplier applied to disciplined repetition. It magnifies time. It magnifies allocation. It magnifies structure. Compounding is neutral. It does not care if it is building wealth or reinforcing weakness. It multiplies whatever system it is given. If you consistently allocate toward productive assets, ownership compounds. If you consistently allocate toward liabilities, payments compound. If you delay investing for 5 years, that delay compounds too. Time does not pause because you hesitate. It multiplies whatever system is currently in place. That is why two individuals with identical incomes can reach radically different outcomes over 35 years. Not because one predicted markets perfectly, but because one reinforced growth early, consistently, and patiently through volatility. Small decisions feel insignificant in isolation. $200 here, $500 there, a financed upgrade, a missed contribution, a skipped year. Individually, they seem harmless. Collectively, they build trajectory, and trajectory compounds. Negative compounding rarely feels dramatic in the moment. It feels comfortable, normal, justified. Positive compounding often feels restrictive at first. It requires delay. It requires discipline. It requires consistency when markets look unstable. But over decades, the emotional experience reverses. Negative compounding becomes pressure, payments, stress, fragility. Positive compounding becomes optionality, flexibility, durability, same force, different feed. When you understand that compounding is obedient, not emotional, you stop asking, what stock should I buy? And start asking, what structure am I reinforcing every month? Because freedom becomes adjustable. Increase your allocation rate and compounding accelerates. Extend your duration and compounding strengthens. Reinvest dividends and ownership multiplies. Transition to income strategically and ownership funds your life. Time is the multiplier. Allocation is the input. Behavior is the stabilizer. Compounding is the mechanism. The force is already running. The only decision left is, what are you feeding? Because the future is not random. It is the compounded result of repeated direction. And direction is chosen, not random. That choice compounds. Every day, in every decision, whether you see it or not.